Infosys just reported a 12% jump in quarterly profit. Its stock fell about 3%. The same week, Reliance reported a profit that dropped 22%, and analysts called it a beat. Read that again. Good number, stock down. Bad-looking number, stock fine. This is not the market being irrational. It is the market doing exactly what it is built to do. Because a share price is not a scoreboard for last quarter, it is a bet on the future. And once you understand that, these two reactions stop being a contradiction and start being a lesson. Here is the idea that unlocks everything. A stock price today already contains what the market expects to happen. Analysts have penciled in the revenue, the margin, the growth for the next few quarters, and the price reflects that consensus. So when results land, the price does not move on the raw number. It moves on the gap between the number and what was already expected. Beat the expectation, and the price can rise even on falling profit. Miss it, and the price can fall even on rising profit. The market is a discounting machine. It is constantly pricing the future and then adjusting. The instant reality tells it the future was a little better, or a little worse, than the price assumed. The headline in the newspaper is last quarter. The price is next year. So how do professionals actually read an earnings release? They almost never start with the headline profit. They run it through a filter, in order. First, strip out the one-offs. A one-time gain from selling a stake or a one-time charge can swing the reported number and tells you nothing about the underlying business. Second, adjust for currency. An Indian IT exporter earns in dollars, but reports in rupees. So a falling rupee can inflate the reported growth even if real, constant currency growth is weak. Third, and most important, compare everything against guidance, the company's own forecast for the road ahead. Only after those 3 steps does a number mean anything. And when you apply this filter to Infosys and Reliance in the same week, the so-called contradiction dissolves completely. Let us do exactly that. Take Infosys first and watch the filter work. The headline looked strong. Rupee revenue up 14% from a year earlier, net profit up 12.2% to about 7,769 crore. But now apply step 2, currency. In constant currency terms, stripping out the effect of the weak rupee, growth was only about 2.4% from a year ago and roughly 1% from the previous quarter. So most of that glossy 14% was not the business getting bigger, it was the rupee getting weaker. Now step 3, guidance. This is where the stock actually moved. Infosys trimmed its full-year constant currency revenue growth guidance to a range of 1.5% to 3%, narrowing the top end from 3.5%. In a discounting machine, a lower forecast for the future is a direct cut to the thing the price is built on. So even with a 12% profit headline, the market repriced the future slightly downward, and the stock slipped about 3% to around 1,023 rupees, with its overseas shares down more than 5%. Notice the exam-style trap here. The number that made the headline, profit up 12%, was almost irrelevant. The number that moved the price was a half-point trim to a forecast most casual readers never even saw. Now Reliance, the mirror image. Its headline profit fell 22% from a year earlier to about 20,946 crore. On the face of it, ugly. What apply step 1? Strip the one-offs. The year-ago quarter contained a large one-time gain from selling a stake in Asian Paints. That inflated last year's base, so this year's comparison looks like a fall even though nothing deteriorated. Once you look at the operations, the picture flips. Reliance posted a record operating profit, EBITDA of about 54,000 crore, up 10%. On revenue up 25% to over 3 lakh crore. That is why the market treated a 22% profit drop as a beat. The decline was an accounting shadow cast by last year's one-off, not this year's business. And you saw the same lesson play out across the tape that week. Dr. Reddy's profit fell heavily on a base effect, and the stock dropped about 9%. While another firm's profit soaring on a low base barely impressed. Same principle every time. The market is not reading the number. It is reading the number minus the story behind it. So here is the lens to carry into every earnings season. When a company beats and the stock falls, the bar was already set higher than the beat, or the guidance disappointed. When a company's profit drops and the stock rises, the fall was a base effect and the real business did better than the price assumed. The headline number is the least useful line in the release. What moves the price is the surprise against expectations and the forecast for what comes next. This is also why the index itself drifted lower into results week, with the Nifty around 23,870, down about 0.5% for a fourth straight session, as the market kept repricing the future in real time. None of this tells you what any stock does tomorrow. It tells you what question to ask when the headline and the price seem to disagree. Not what did they earn, but what did the market already expect? If you like taking earnings day noise apart like this, subscribe for more. This is educational, not financial advice.